Mark Carney, when central bankers like you get together, here or elsewhere, and you think about the state of the world economy, do you think, thank heavens, that's all behind us?
No, not at all. Where we are, some of the worst of the crisis is behind us, but the aftermath of the crisis is very much with us. So in a number of our economies, including the UK, the financial system isn't fully repaired. It's not functioning as well as it could and should. We have debt overhangs of households and governments, which are holding back recoveries. And we have, quite understandably, a great deal of uncertainty out there amongst households, individuals, and businesses that are preventing particularly investment. And we think those factors, those three factors, are going to persist for some time, and that helps affect, or that does affect, how we set policy. We in Britain had 4 or 5 very tough years. So we're just getting to the point where the level of economic activity in Britain is the same as it was in 2008 before the crisis, which is somewhat an unprecedented period of time in order to come back. But there's momentum in that economy.
The one fly in the ointment, of course, is the Bank of England's economic forecasting, isn't it?
Well, if our forecast is going to be wrong, it's better to be wrong in the direction it was. I mean, let's be clear. Good news is good news here. We've got unemployment coming down faster. These are private sector jobs. They're high quality jobs.
Sure, but this is 2 years ahead of when you said it would happen.
It's 2 years ahead of the most likely scenario that we saw at the time. Because if I can put this into the context of the recovery, because it's quite important to the sustainability of the recovery, is one of the big questions for the UK, and the UK more than any other major advanced economy, is what's going to happen to productivity in the economy. When is that going to start to pick up? And what has happened in the early stages of the recovery is there's been very little productivity growth. That's the bad news. The good news is there has been this employment growth. We need both ultimately to have the sustainable recovery.
But we're almost at the point now where you had thought it might be appropriate to look at interest rate levels.
What we said, we made an easy call when I came in, which is to say it would not be appropriate to even begin to think about raising interest rates until we saw the economy really growing, jobs really growing, incomes really growing. Now, we used one figure in order to capture that idea.
Was that a mistake?
Unemployment. No, it's not at all. I mean, if you look at
we're now almost at it. The unemployment figure.
Would you rather be at it 2 years from now or be at it now?
No,
I go back. Good news is good news. We've got inflation on target. We've got unemployment coming down. We've got the economy picking up at a rate, finally, that is above its trend, finally starting to close the gap of where it should be relative to where it was. So this is good news. And we've made it very clear to businesses and to households across the country that we're going to take stock once we get to 7%, once the economy gets to 7% unemployment rate, and consider the appropriate stance of monetary policy. Now, we don't see an immediate need to change monetary policy. We said that this week. And in fact, I'll reinforce it and say that even when monetary policy changes, given those headwinds that we talked about at the start in the global economy very much affecting Britain, we would expect any adjustment to be very gradual, because the important thing is to set monetary policy in a way, in a fashion, that's going to ensure that this economy is really and sustainably growing.
So it will be re-examined when we get to 7%?
It will be. We have an inflation report. I know you're an avid reader. It's coming out in February. And we will do the examination there because we're close enough to do the examination people want to know.
Would you imagine that interest rates might rise?
There's no immediate need to increase interest rates. I think if I may give a little more color to that, is what we've seen is the unemployment rate come down. But we've also seen a lot more Britons want to work, looking for work, and we've seen that they want to work longer hours than they had previously. In part, that's because of where wages are going. So there are indications of more slack in that labor market.
The figure you've chosen of 7% is your choice. Could it be redefined and be as 6%, 6.5%, 6.9%?
Well, there's a broad range of things that we could do. I wouldn't jump to that conclusion, though. First off, it is a decision of the entire Monetary Policy Committee. And secondly, what we're trying to get across, and I think what has been people understand, is that it's really about overall conditions in the labor market overall amount of slack in companies, and that's what affects it. And so we wouldn't want to detract from that focus, which really is properly developed both in the market and amongst business people, by unnecessarily focusing too much on just one indicator.
But it has a nice clarity to it, doesn't it?
It has a nice clarity. I'd remind, if I may, that when we put this in place, we were just coming off the cusp, the UK, of a triple dip scare for a recession. There was tremendous uncertainty about the stance of monetary policy. There was a split MPC committee, and business had been facing a lot of uncertainty, and households. And so what we were looking to do was provide clarity. I think we're in a different place now.
You sound to me as if you feel like a man rather on the hook of his own making, which he wishes he didn't have.
Not at all. Not at all. Look, good. I'm going to repeat myself because it's right. Inflation's back at target. 300,000 jobs, private sector created in the last quarter measured. One of the strongest growing at the moment, strongest growing economies in the advanced world. The recovery has taken hold. The question is converting that into a sustainable and balanced recovery.
Do you worry about there being a housing bubble?
We worry about the momentum that's picked up in the housing market, that without question. And what we have done, what we did in November, is we took some initial steps to address that momentum. We took our foot off the accelerator. So we're not hitting the brake yet on the housing market, because transactions are about 3/4 of what they were before the crisis, the longer term average. Mortgage approvals are about the same level. Prices have bounced off recent lows. There's much more to the housing market, as you're well aware, than just what's happening in London and the Southeast, and we have to make national policy.
Can I raise very briefly 3 other points with you?
Okay.
Have you spoken to Ed Miliband since you dissed his banking policy?
Since the second part of that question isn't true, then it would be impossible for me to put it in time.
You said capping bankers' bonuses in the way that he was proposing wasn't a helpful suggestion. You further had queries about his ideas of cutting banks down to market share.
2 things. One, we have responsibility for financial stability at the Bank of England. And when we look at the banker bonus issue, we look at it from the perspective of financial stability. It is worse for financial stability to pay a banker all in cash today than to hold a bunch of that money back and put it in shares and other things, and have the ability, and for that money only to show up well down the road when the risks that that banker has taken show up, or the misconduct that that banker has performed shows up, and have the ability to claw that back.
Could Ed Miliband's banking policy possibly work?
Well, there's a range of objectives. I think what the Leader of Opposition said, subsequent to my comments about different aspects of the issues, what he subsequently said in his speech, was that he was going to refer to the relevant authorities, which are not the Bank of England, it's the Competition Market Authority. So they would make that decision if it were to come to that.
Okay, let me invite you to stick your hand into another hornet's nest. Could an independent Scotland retain the pound?
There are issues with respect to currency unions. We've seen them in Europe. It's one of the factors that affects actually the outlook for the UK economy, has affected us over the last 5 years, affects us going forward. The challenges of having a currency union without certain institutional structures. I'm actually going to speak to this issue, use your program as a plug. I'm going to speak to this issue in Scotland next week, and I'm certainly going to meet with the First Minister prior to doing so.
Would you look forward to managing a currency of which Scotland was a part?
I'm a public servant, and I and my colleagues would implement whatever remit we were given.
All right, one other question. I wonder, when you look at these so-called cryptocurrencies like Bitcoin and the like, do you ever think that the life expectancy of somebody in your position, not you personally, I hope, but the life expectancy of national bank governors is distinctly limited?
I don't, actually, for this reason. Certainly it's interesting what's happening in this regard. But the experience of what I would call free banking, the experience in the 19th century in the US and Canada, where banks themselves could issue their own notes, was that you had much higher rates of failure because almost inevitably, not in every case, the incentive to issue more notes in order to keep things going is there. And whether those notes are electronic or physical, there is a need to have an independent entity. This is what we've learned over centuries, an independent entity with a clear remit, a clear objective, like a 2% inflation target, as the Bank of England does, that is accountable to people, and part of that accountability is meeting you.
Got any bitcoins yourself?
I do not.
Would you like to have some?
I can't invest any money, so investing in my children, Jeremy.